Need help with tax, don't know what to do. The Brysons are here for you. We know every tip and trick. The serious tax talk with a Louisiana twist.
Welcome back, everyone. We're here for today's episode of Talkin Tax. It's Kerry and Angie Bryson again. And today we have a very interesting topic, I believe. Well, interesting for us, but maybe not for everyone.
Interesting?
Yeah,
I
interesting.
think that's an overstatement.
That may be the wrong word, but we actually are going to get into solving cases.
Right.
We're going to get into the nitty gritty of an important fact, what you need to know and understand when trying to resolve your IRS tax liability with the IRS. So
you have a tax problem. This is probably pretty interesting.
I think it's one that on its face is very misunderstood by people that don't understand how to use it appropriately. And it's an area, I don't want to say, but I'll say the IRS takes advantage of people in this regard because they don't really know how to work the numbers, and on their face, I think it's somewhat misleading.
Yeah.
And I think this is an area where the IRS really takes advantage of people. So what we're talking about is the payer's ability to pay. And there's two real big factors that the IRS is going to determine while resolving your case. And one is ability to pay, and the other is collection potential. So today we're just going to focus on ability to pay.
Right.
So I guess we'll start. I just want you look like you're ready to tell everybody what ability to pay is all about.
I am?
Yes, you look like it.
Well, I mean, ability to pay, sort of my talking point with clients is usually it's a snapshot in time, real time, of your cash flow, basically. Your income less your allowable expenses. So that's kind of it in a nutshell. What would be left over at the end of the month or the end of a given time period to fund your IRS tax bill? That's sort of my talking point with clients whenever we're discussing that.
So you mentioned two things, and I guess we'll break it down.
Right.
Since we're getting in the nitty gritty here, let's break it down.
Right.
In general, it's your income and your expenses. I mean, that's what we're talking about. But income, I think we need to understand what income is and expenses. So income, since that's the easier one, I'll take that one. That's everything you make and everything you earn, your wages, any kind of dividends, royalties, interest, anything that goes on income on your tax return is going to be considered income.
Passive income too,
Yes.
not just,
Yes.
Right.
Oil royalties. Any money you earn is going to be considered income, and it's broken down into a monthly matter. So it's factored monthly, and the purposes for ability to pay, they determine your monthly income that's derived from all sources. And then the next step is to determine, and I guess I should say too, and people, because it gets a little confusing, on the income, we need to mention it's also Social Security. People think, well, my Social Security is not, but it is your income. And for purposes of the ability to pay, your entire Social Security amount will be taken into consideration and be added as income.
Right. It's your gross income.
Yeah, it's the gross income. It's everything that you have to spend on yourself and your family for the month. So Social Security, any other pension, wages, royalties.
Gambling, winnings,
yes,
whatever.
Anything that you receive as income wage-wise.
You want to say
I'm going to say one more time. It's income.
One of the big triggers here is calculating your income. So this is where the IRS takes advantage of people essentially not knowing what the definition of what their income is. So if I'm self-employed, my income could be seasonal. It can vary. I may have made a lot of money last year, but I'm not making a lot of money this year. Or, flip the script. It could be I'm making a lot now and I didn't make a lot last year. And so it's important when you're calculating income and you're not a wage earner making the same amount of money every single month, that you understand that there is some artistry And there are some arguments to be made when you're presenting your income to the IRS. So if for example, we have a client who's in the lawn business. Their work is seasonal. They work a lot during the summer, make a bunch of money, mid-year, and then everything kind of dies down. Crawfish farmers. We have a couple of crawfish clients. So
Crawfish former client.
crawfish, whatever.
Yeah.
Yeah, that. Yeah. We don't have clients who are crawfish.
Yeah, okay.
Let's be clear. So be careful if you're calculating your income for purposes of determining your ability to pay, that you understand and that you have some artistry in how you present that number to the IRS, right?
Okay. Yeah. Good point.
I didn't mean to
And
jump
you're
ahead,
right.
but
No,
yeah.
I was being general again, and I told him we were going to get in the nitty gritty. We probably do. So,
Right.
so
Yeah.
let's dive down. So there is another step though, or another point I think we should make at this too, because we're talking about small business, being self-employed, which a lot of these clients, but even wage earners, I've had several cases where as a wage earner, but he worked a lot of overtime
Right.
in the last month.
That's
And
a one-time deal.
the IRS looks
Not a
at that
bonus or-
that last paycheck, and they see that, then they take all that as income. That's the only time they work overtime for the last 3 months. And so what do you do in those cases? And that's, I think, another case where people get taken advantage of because the IRS just uses last paycheck, and the people, it's it's right at Christmas and they're working a bunch of overtime or something like
Right.
that.
Right.
So what do they do? How do they handle that?
Well, when you calculate the income, you have to look at all of the different scenarios for a given client that are within the acceptable lanes for the IRS, right? So, when we do it, we have a creative approach. As long as it's within the bounds, like I said, we'll calculate income based on multiple different scenarios. And whatever is the best picture for the client is what we come up with. Custom crafting is important for what we do. There's no cookie cutter solution. So you're for 33, we're married, obviously we have the same, might look different than somebody else in the same situation because your facts and your circumstances dictate that that's a better presentation for you, for us to present on your behalf. Yeah.
So income, since you use me as an example, income would be a point that should be made here. If you're husband and wife, then it's going to be both spouses'
Right.
income. And what if one of my children works and lives at home?
Yeah.
Yeah. So it's all
if they
income.
contribute to the household.
It's all
household.
income in the household is supposed to be considered as long
Right.
as they're
But
contributing to the
typically
household.
they're not out looking for
I don't have any kids or
college
any
kid.
children who are contributing to the household. I can tell you that.
That's
There's a lot
not
being
fair.
there's a lot being
fair.
taken out, but not a lot coming in. So anyway,
No,
that's a story for another day. We'll leave that.
No, but you're right. Like even boyfriends or girlfriends, or roommates, if the IRS becomes aware that you have anybody assisting you in your household with bills and whatnot, then that becomes a factor in the income portion of.
And boy, that's a big one too. I'm glad you brought that up because that is a big one. When someone, you have roommates or something and people are living together and I don't want to be a part of that. I'm not giving you, and the IRS is if they're contributing to your household that you're living in and are reducing your expenses by contributing the money, then the IRS is.
Well, we need to have a conversation about that.
Yeah,
it's
they're
not.
going to be
it's not
asking.
a given. It's not an
Yes.
end all be all, but it can be a factor in our analysis.
Yes.
In the analysis. Yeah.
Okay.
Right.
I think we've covered income pretty good. You want to move on to expenses, or we still got more to go?
No, the only other, yes, actually I have one thought. So there's usually, pretty much always, the IRS will, if you give an income number to the IRS, so let's just say I'm making $2,000 a month, they will audit that number. Well, they request bank statements and documentation to prove your amount that you're claiming on this form, but they'll also audit that with your last tax returns. So if I say I'm making, $24,000 a year, $2,000 a month, they're going to go look at my prior year tax returns and audit that with my bank statements. Current. So, if those don't match, it's not necessarily that it gets kicked out or it's not wrong. You just have to explain that. And that's important to consider that, I guess my point being is there's some legwork on the IRS side that they do to audit and verify what you're sending and what numbers you're using.
Yeah, it's not taking it face. Yeah,
No,
it's not taking it face
and
value. Yes.
accuracy is important.
So you mentioned, and I guess we should say, since we're trying to be particular here, you mentioned the form, and we maybe glossed over that. I know in the materials that'll be online, we have a snapshot of the form that's actually used,
Yeah.
but we didn't really talk about it. So the form is a 433 for
Collection
individuals. It's a
information, yeah.
collection information statement, and the IRS basically is going to require that in every case. And that's really a financial statement. It's in the section that we're referring to is the monthly household income and expense section. If you ever have to complete one, you'll know what we're talking about. It's
Right.
going to ask for all this income that we discussed. So
Right.
that would be what's included on your form. And as Angie referred to, we use in our practice, we work it, 3, 4, 5 different ways.
Right.
Average 6 months, average 3 months, average the last three years, whatever.
Project.
Try to figure,
Mhm.
make it,
Future.
and come up with the best number that we can get for the client. So I would recommend that someone do that. I mean, don't just get locked in on one.
I made this month and I'm
locked
here.
in and you're done, and that's all you can do. You get a little creative and try to get that number. Without getting a lot. I mean, the simplest thing is the lower the number, the less ability to pay you're going to have. So the lower
Right.
income number you got, you definitely don't want to exaggerate it.
Right.
Because if you do, you're going to end up in a bad deal.
I'm glad you said that because oftentimes it's clients and even practitioners confuse this part of our work, what we do with how much they owe. The taxpayer particularly owes. So your ability to pay, which is your income, we're still on the income factor, but your income minus your expenses is your ability to pay. What's left at the end of the month? How are you going to fund this payment plan or whatever you're going to propose? It might be zero, right? A lot of practitioners and taxpayers confuse that with how much they owe. So your ability to pay is your ability to pay regardless of whether you owe $1 million or $1,000. And so this analysis is totally independent from how much you owe and what your tax bill is on your tax return. Now the numbers, the income and all the other numbers, the factors you use to get there are married in the sense that they audit and they reconcile them. But it's important to know that your ability to pay is not a factor of how much you owe to the IRS.
Yeah.
Right.
So let's go ahead and cover the expenses section because that's a little bit more granular than income actually, and it's a little bit harder to do.
Well, I think people miss opportunities on the income side. So I can't emphasize that enough. It's okay to be creative and honest with what you're going to make in the future.
So when they calculate expenses, it's pretty much everything you need to, it's all the expenses you live. I mean, you need to live, and the form will go through and food, clothing, housing. There's a long list. Vehicle payments,
shelter, right? Yeah.
Health insurance premiums. Even child support payments or court-ordered payments that you have to do.
Right.
Life insurance premiums. Your monthly taxes, and man, how many people that we see do this forget to include their monthly taxes. Right. And that's so important because if you don't put your monthly taxes, the IRS is not going to put it for you. And then you're going to end up getting a deal where you can't afford to pay your monthly taxes as you go. And then you're right back into the problem.
Well, that's the problem. How often have we seen it?
Yes.
Clients call up the IRS hoping to get some resolution. The first thing the IRS person does is start to take this financial statement over the phone, right?
Absolutely.
Right. And they don't even know what's happening. They just start giving out information and guessing over the numbers, and they end up in a payment plan, which is typical that they can't afford.
Right.
So, back to the expenses, but it's in the show notes, but food, housing, utilities.
And that's taken straight off the form. The form, the 433 that we're talking about, those expenses, those aren't made up. Those are straight off of the 433.
Right. But if they're not in this list, they're not factored in the formula.
Right. Unless you can do the other.
Make a request.
And you know how to justify doing another expense, which is not easy.
Right.
And it's not that we always get other expenses included. Well, I would say
depends.
it's very difficult.
May have
you got to have a legitimate.
Right. You may have a state tax bill that you're funding that you can add, you can put on there.
But the same, I would point out though, too, the same thing applies with income as with expenses. Don't don't just look at the last month and go the last month. I mean,
Right.
let's look back over, 6 months, 3 months, last year. Let's try to average and see which ones are, in this case, higher.
Mhm.
You want the most expenses, lowest income, most expenses.
Right.
Gives you the lowest ability to pay. And that's what you want. You want a true, low, non-exaggerated ability to pay number that's going to be used to determine your resolution option with the IRS. So you really know how to know, just like the income, you know how to work the expense side as well. So look at it and average it over 6 months, just like you were talking about with income. I would do the same with expenses, do that same thing.
Yeah.
So the only difference here, though, maybe I'll get you to explain it, is, with expenses, we have, these collection standards, what are those? And, it's not, in income, it's just my income.
It is a number.
But in the expense section, the IRS has determined what's allowed expenses, and in infinite wisdom, they know how much it takes for us to live
Right.
in, either locally or nationally, depending on the expense.
Right.
So, why don't you explain that? Kind of go through
Well, I
those.
mean, I think, you hit the nail on the head. It's not expenses. It's not your raw expenses person by person by person. Income is, right?
Yeah.
But expenses are based on what the IRS deems allowable. And I think that's the key word. The trigger is allowable. Now, again, it's back to what they've deemed allowable. So there are some ceilings for, different your housing and utilities. So for example, you can't have a $5,000, I'm just picking a random, a $5,000 house note. They're only going to allow what's allowed at that given, and they do change. The housing expense, there's a limit on there. The car expenses, there's a limit on. And if you put those raw numbers on your form and you get to your ability to pay and calculate it to be 0, for example, they're going to deviate. They're going to go back and add or subtract from your expenses. So it's going to change that number.
They're going to stick to the standard, what you're saying is,
Right.
unless a higher number than the standard is.
You can.
But it rarely am I successful in that, but you can be.
Well, right
there
now,
are situations.
we're asking for a deviation on the car expenses in our cases because of the price of gas.
Price of gas. And
so if you're someone who has to drive for work and your mileage reimbursement rate is not matching what your cost, your
it's
actual
costing
cost
you more
is,
to drive.
we're asking and the IRS is not keeping up with these adjustments, right? They're not adjusting them every month based on the price of gas. I mean, they don't move that quickly. So that's an example.
So like an example, the collection, I'm reading on the show notes here. For food, clothing, and miscellaneous items, it's $785 for one person.
Right.
It's $1,410 for two, $1,610 for three. So it was really get a big drop there as the larger families.
Not a factor of 1 to 1 to 1.
The $1,900 for four.
Right.
And then each additional person after that is $344.
Right.
So it goes on. So it depends how many people live in the house. And this standard, though, what's neat about this one, good thing about it is you really don't have to prove it. You kind of just get to claim it.
Yeah, it's just an automatic. I mean,
you don't have to go give a bunch of documents. I mean, they kind of allow this. So if you're going to go over, you better have the documents to support it and then ask for the deviation. But this is something that I see a lot of people make mistakes in because they're not considering, like I have people that come in and say, oh, my one person household, it was $400. That's what I spent on food. And I'm like, well, wait, what about your clothes? And what about your other, did you buy, shaving cream? Well, yeah, that's food. And they misunderstand. So they will actually go lower than the standard. And if you go lower than the standard, the IRS is going to stake the lower number. They're not going to give the standard.
Right.
So in no case should you have a 433 that has a number lower than standard item on.
Well, I would say that most of the
items.
I've never had a situation where I asked the client, once I asked the client, okay, are you sure?
It wasn't understood.
It was all, it's always more than.
These numbers are not that, it's not, I know what it costs for a lot of people because we've done this a lot. And it is so rare.
I've never had a situation where someone didn't meet the standard. Yeah.
Yes. Right. So let's talk about, the standards. So there's standards.
And those are in here, what they are, like the number.
But there's standards for each expense.
Right.
For the most part.
Right. They're there.
Some are national, some are local. And
based
then
on
you look up the chart is on
parish
IRS.
or county.
It's IRS.gov.
Right.
You can see the chart. You can see the expenses.
Yep. You just
And
type
you
in
just
allowable
yeah,
expenses.
you look them up, and that should tell you for your situation, whether you're a family of four, you single, whatever, but you should be able to complete the form with the standards and get that. What about healthcare? That's another one where I see people, they, for whatever reason, they just put zero. I don't spend anything on healthcare. Everybody spends stuff on healthcare. I mean, it's
where you get your teeth cleaned,
out of
hopefully,
pocket.
you
Yeah,
get
it's
checked up, you go to the walk-in clinic,
right. You buy
your
vitamins, you
kids
buy
buy,
this.
yeah,
There's a lot of
eyeglasses,
yeah, there's
a
so
hearing
much.
aid,
And the standard is $75 per month.
right.
And if you're
Unless
over
you can
65, it's $153 a month. So those are expenses, and this is a nationwide expense. So
Yeah.
you might have to look it up, the national one.
Right.
And this is another expense, like we talked about, that doesn't really have to be substantiated. I mean, the IRS knows that your people are spending it.
Yeah,
but
but
once
look how
again,
low that is.
right, look how
I
low.
mean, come on.
Once again, if you
You
put zero, though, guess what? The IRS is going to put zero. They're not going to go fill it in for you.
Right.
So, I would encourage anyone completing a 433 to at least go look at the standards and understand them and use that as your framework, as the numbers that you're coming up
Yeah,
with.
I'm thinking of a situation where someone put their current health care and out-of-pocket medical costs on their form, but in the process of actually our representation, one of the spouses was diagnosed with cancer. So we had a number on the form that became inaccurate. Before we had to rework the form again because guess what? This person was going to have anticipated, chemo and all this other health care. So we had to go in and project what the cost of that health care was going to be, or the treatments and whatnot was going to be. And basically just tell the IRS, like, this is what we think it's going to be. And it made their ability to pay zero once we got that done. So that's an example of where, you've really got to be projecting what's not just what happened in the past, but what is going to happen in the near future for you.
Yeah.
Yeah.
Okay. So that's how the financial standards work. We could go with a vehicle if you want, but I mean, they're all posted on the IRS.gov. There is a national standard, and then there's the regional standard for operating costs, but a national standard for the purchasing or for the payments, I guess.
Right.
For the payments that are allowed.
Well, I think it's two vehicles per household too. I think that's important to mention.
Even not for a single household, they only get one.
Correct.
But if it's more than one person in the household, it's two.
Right.
Yeah.
Right.
And a single is $588 for payment. And so, and we often tell people, that need a new car, they come in, they want to solve their problems, they need a car. Like, go buy a car, but don't spend over $588. You need to go buy a car, because if we don't have a car payment and we put zero on the form, they're going to take it as zero. And then next year, you're going to need a new car, and you're not going to be able to afford it because you're going to be paying the IRS the money that you need to be using the car. So you got to work your numbers and get them right, and get your situation right before you go to the IRS.
And some people don't want a new car.
They're not. Absolutely.
They would rather pay the IRS, because that's what it typically washes. You're either going to pay your car note, which is allowed, or you're within that ceiling, or you're going to pay your payment plan to the IRS or whatever we land.
And that was the point I was going to make.
Right.
Before we left, I remembered. I don't know if we were clear, and I want to be clear about this, about the ability to pay, because if your resolution option is installment agreement, just not just a simple installment agreement, not a streamline or anything like this.
Right.
Where
A financial based one.
Right. A financial based installment agreement. It's not on any of the programs or any Fresh Start or any of that stuff. It's just a basic, which is the majority of cases that we deal with anyway. Your ability to pay ends up being the amount of your installment agreement with the IRS.
Right.
So if you end up having a exaggerated ability to pay, then your payment to the IRS is going to be exaggerated.
Well, it's something you can't afford.
It's going to be very painful.
Right.
If you work it correctly and get it right, you get a good number that you should be able to afford with your expenses, then you get a decent number, and you get an installment agreement that you can live with. So this stuff is very important. But when the first thing they do is start doing the 433 when somebody calls needing assistance.
So
They start.
unfair.
It's
Right.
so unfair because the taxpayers aren't realizing that that's the numbers that are going to be used to determine their payment.
Right.
These payments, on these installments aren't just picked out of the air.
Right.
They're not
Or they
just made
shouldn't
up.
be. Yeah.
And it's based on this financial information, and they should know. And the IRS is not allowed to make you pay more than your ability to pay.
Well,
There are exceptions, of course, but for the most part, the IRS is not going to force you to pay more than your ability to pay. But they also are not allowed to accept less than your ability to pay, without getting some kind of approval and a lot of other things. So, the basic general rule is your ability to pay is going to equal your payment. That's how you ought to approach it, unless you really know how to deal with the IRS and you deal with it before and you know how to deviate off of that. But for the most part, that's going to be the rule. That's where it's going to end up.
Right. The really hard cases for us, and I think you can attest to this, are when the ability to pay based on just the allowables, not factoring in other expenses, like you don't get to put that in the formula, so they're not allowed, but they're real expenses. When those are not allowed and the ability to pay comes in too high.
Well, the classic one
technically
is
not affordable.
Private school tuition.
Or college tuition.
Yeah, college tuition, which,
right.
A lot of people are, pay and want to pay, but those are not allowed expenses in the IRS's wisdom world. So,
your ability to pay on
your ability to pay is going to be a lot higher than what you're going to show on a 433, because you're not allowed to include those expenses for the most part.
And those are very difficult cases, and those require a lot of conversations with clients on how to get them to a place they can afford the payment plan.
Yeah, and we should also add too, we talked a lot about installment agreements, but in other resolution options,
everything.
This is going to apply to everyone.
Everything.
The settlement, the offer and compromise, which I think we've talked about already, maybe in an earlier podcast. I'm sure it'll come up because we do it, because the offer and compromise, the trick to getting a good offer is not having an ability to pay. All goes back to the same form,
right?
Same 433, which is going to be required in every case. If you have a hardship, if you want to convince the IRS your hardship, which they call currently not collectible status, you better not have an ability to pay. You better be able to convince them that you do not have an ability to pay, that you are in a hardship,
right?
Or you're not going to get it. So, so the 433, it's not just limited. I wanted to make that point. It's not just limited to the installment agreement. It applies to every resolution option.
Why?
That's why when you make that phone call and they finally answer, and it takes a long time to get an answer. But let's just say they finally answer. Right. They're immediately going to start asking you about income and expenses. And they're completing on their end, they're completing a 433 based on what you tell them.
Right.
Then they're going to have you fax pay stubs and check stubs. They're not going to be trying to average and do anything that you need to be doing what's in your best interest. They're going to be doing what's in their best interest. And they're going to be trying to get that number, your ability to pay, as high as they can.
Yeah, so that's a great point.
Yep.
Yeah. I call this the beginning of this financial statement, the linchpin of the case, because it's done in every case, based regardless of what your resolution plan is going to be.
Well, frankly, from our perspective, or from anybody's perspective, you can't really know what's in the best interest of a taxpayer until you complete this.
See this picture.
And you complete this. That's what when I started out with it. We're kind of getting the nitty gritty here, because this is every case. This is what we do, and we know how to, this is where you work the magic on solving these cases, is with these 433s. If somebody does a bad job, 433, they're going to get a bad deal. It's just the way it works. And if you do a great job on the 433, then you get a pretty decent deal.
Yeah.
And that's just how it is. So it is that important. Anything else, or we need to cover? I think we kind of covered this.
Yeah. Just be careful. Make sure it's accurate. The other thing is you do have to sign this, the end product. There's some other components to it. So it's
kind of an important point.
Important.
It is subject to perjury.
Once you've nailed down this document, if it gets submitted to the IRS, the taxpayer, not us, and nobody in our firm can sign on your behalf this document. You sign it under penalty of perjury. And we have had some clients not under our watch, essentially, but where the government's questioned the accuracy of their information.
Yeah. And when you do that, the IRS
Criminal,
will refer it to the criminal division.
right?
And that's a whole new
Your
ballgame.
liberties, is
That's
not your property.
yeah.
Your liberties. Is
That's a different world there. So
right.
we can talk about that
Another
today.
time.
Yeah. So, okay.
I think
Anything
that's a wrap.
else?
Yeah.
We'll just send us off then.
Yeah. Okay. All right. Well, a lot of information about collection information statements, nitty gritty, like Carrie said, but we are here to help, standing ready. If anybody has questions or comments or needs any additional assistance, let us know. We can always be reached at brysonlawfirm.com. So give us a shout, and thanks for listening. Until next time.
Bye-bye.
Bye-bye.